But if you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16, and then it got to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. You flip a coin, you walk around the block, what do you do?
Today, we are learning from one of the greatest investors in history. Peter Lynch was a legendary mutual fund manager at Fidelity Magellan Fund. He achieved a 29% annual return, absolutely crushing the stock market over 13 consecutive years. During that period, he managed to grow the fund's size from $18 million to $14 billion. Afterwards, he retired early at 46 years old. And now, Mr. Lynch is sharing with us how to make millions during a stock market crash, a very important thing to know in today's economic conditions.
You should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly, but we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine. You're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own. One of the things I find a couple of rules I want to throw out that I find useful, excuse me, is a lot of times people buy on the basis the stock has gone down this much. How much further can it go down? I remember when Polaroid went from 130 to 100, people said, here's this great company, great record. If it ever gets below 100, just buy every share, and it did get below 100. A lot of people bought on that basis saying, look, it's gone from 135 to 100. It's now 95, what a buy. Within a year, it was 18. And this is a company with no debt. This is a company that was just so overpriced.